Seasonal marathoners like myself use the off-season to add to what we call our base miles. These training runs and accumulated miles help to build our aerobic capacity. Increased aerobic capacity helps the body convert fats to energy, thereby increasing our endurance.
The markets are likewise in a phase where it makes sense to add to our portfolio's ability to endure for the long run. The markets have hit new highs at least 25 times this year. During times like these, it is very prudent to position our portfolios, like we condition our bodies, for the challenging times ahead. The expansion is now in its 6th year, with the S&P 500 index of the stock market gaining nearly 200% since the bottom on March 9th of 2009. The 4 cyclical sectors, automobiles, housing, inventory, and capital expenditures, which typically drive economic expansion, are generally headed in the right direction. Automobile sales recently hit levels unseen since 2007, with annualized sales volume of nearly 17 million vehicles. Housing starts bounce back from their weather-impacted first quarter declines and continue working their way back to normal, currently running at just over 1 million starts annually. Manufacturing and trade inventories have been in ranges that most economists would consider to be normal levels for several years. Real capital goods orders, that's business investment in buildings, machinery, and equipment, remain at above average levels, but not enough to improve long-run productivity. Jobs continue to follow the traditional post-recession pattern as unemployment peaked during the recession and has been slowly improving during the recovery. Inflation is always on people's minds, but until the consumer begins overspending and interest rates begin to rise, we are not likely to see huge gains in inflation. Growth in the U.S. economy is, in my opinion, likely to continue in the 2% to 4% range for the foreseeable future. Yet, as solid as the economic numbers appear, many stock market pundits would describe it as overvalued because forward-looking price-earnings ratios are high. I believe this assessment is simply not true. Evaluation must be considered in light of the facts. Price-earning ratios are high because corporate earnings still have lots of room to grow. I believe consumers will become much more confident and start spending a lot more money. Consumer spending makes up more than 2/3 of our economic activity, and the consumer simply has not returned to pre-recession spending habits. A much better indicator of a pending bear market, according to Jeffrey Kleintop, is an inverted yield curve, which has preceded all of the past 7 recessions. The Fed would need to push short-term rates to exceed the 10-year rates, and with conditions as they are right now, it is likely to be years before we get anything approaching an inverted yield curve. International markets tend to have additional risks for U.S. investors, including exchange rate, taxes, government integrity, and accounting rules. I believe that the European economy has most likely bottomed, and emerging markets have had a very difficult couple of years. There may be opportunities in these markets to add good investments and geographic diversification at reasonable valuations. As alluded to above, we have some long-run concerns about productivity and labor force growth. Worker productivity gains have been lackluster to say the least, with just a 0.5% gain in 2013. When coupled with a declining labor force, due in part to baby boomers retiring, this could prove detrimental to sustained growth in the future. The abnormal bond market, as has been noted the past few years, is at or near record high prices with the corresponding record low interest rates. This situation is not static, and it is likely to begin to change direction sometime in the future, putting pressure on bond investments. The current government regulatory environment seems premised that business is inherently dishonest, lazy, and self-serving. I believe most business people are basically honest, hardworking, and actually care about others. I would very much like to see us return to a regulatory environment of Ronald Reagan's trust but verify attitude, with regulators standing by to provide that verification that helps to keep people honest. With both the stock and bond markets at or near record high prices, there's opportunity to reduce risk. Contact us for a complimentary consultation to learn how we would position your portfolio to endure. Because
at Enduring Wealth Advisors, we're focused on the long run.